This debate about AT1 bonds has played out, I think, for the last week or so, ever since the first announcement came through. I think the bank in its communication over the weekend was very clear that the point of non-viability has been reached. These are loss-absorbing instruments, and contrary to what was being spoken of very widely, even in well-informed circles, you don't need an equity write-down to write down AT1 bonds. You think they're justified in doing this?
Sadly, Ira, I think they are. And even the original draft that came out from the RBI, which suggested that AT1 bonds would be written down completely, was absolutely within the law. Here is the reason we have a lot to introspect, Ira. Actually, Basel III norms allow for a variety of ways to treat AT1s when this point of non-viability is achieved, right? You can actually have conversion to equity, you can have a partial write-down, you can have temporary write-down to be written back in case things improve from there on. Funnily, I guess a class of investors did not want that clause of convertibility into equity. In fact, I've seen some of the information memorandum for at least one of the bonds, which specifically says if Section 45 is taken recourse to, then the entire amount will be written down to zero. And there's not even a clause there which is otherwise allowed by regulations to say let's convert that to equity. Because if you had an equity conversion clause, it would not fit into a certain scheme, which is a debt scheme, or it would not fit into a certain mandate, which is an investment of only into debt, not into equity instruments. So in a way, frankly, there are a lot of questions to be answered by people who are managing risks on behalf of others who took on these particular bonds. Clearly, by looking at the documentation, they should have known that the risk was equity plus plus. I'll just add one element here. Sadly, some of the issues of mis-selling have also come to light. It appears that retail investors, and not necessarily HNI, high net worth individuals, but retail investors have also been asked to put money into these AT1s. That to me smacks of gross mis-selling. I don't want to pronounce judgment without knowing the full details, but that clearly merits an investigation as to how relationship managers or advisors would actually get small investors to put money into AT1 bonds. Are they really the right people to sell these kind of bonds to? So a lot of questions which emerge, but unfortunately, I think as in respect of AT1, the final denouement is right. The documentation is extremely clear. The spirit of the instrument is also extremely clear. What has happened both by Yes Bank and was proposed by RBI is absolutely right.
No. Professor Mohan, your thought on this AT1 bond write-down, do you see it any differently, or do you agree with Ananth?
Well, I agree with Professor Ananth Narayan. I don't see much ambiguity in respect of AT1 bonds, and what the regulator has done, I think, is technically correct. And you have to understand that without the complete write-down, the equity requirements would be that much greater. And we have to appreciate that even at this point, with SBI and others coming in, the infusion that is taking place is perhaps only 50% of what is required even at this stage. So there's really not much room to accommodate the AT1 investors, even if in principle such accommodation were possible, because the situation is quite dire. And I think a complete write-off of AT1 would certainly be a requirement for survival of the bank going forward.
There would certainly, Ananth, be some impact on the pricing of other such issues, but perhaps it's just pricing in the right level of risk now.
Oh, absolutely, Ira. So, the way the documentation read, as I mentioned, for that specific IM that I saw, that instrument was even riskier than equity, right? Clearly, as you said, it wasn't necessary for equity to go down to zero before this instrument went down to zero. And unfortunately, given that, look, we shouldn't beat ourselves out too much. We are a growing economy. We are learning these nuances as we go along. But there was definitely an element of mispricing of these bonds. A lot of people who invested in these bonds probably ignored or did not recognize the true nature of the risks. I think we'll come out of this. A lot of people are saying, listen, AT1s will stop going forward. I don't think that's the case. Yes, they will get repriced. They will have to, the documentation has to be changed to allow for easier exits in case things like this happen. And absolutely, the pricing has to go up quite dramatically. One thing I'll add up quickly out here. I think we should be glad that the RBI in the solution has not touched tier 2 bonds or some of the senior secured bonds. At a point of non-viability, frankly, the ambit is very, very open for the RBI. The RBI could do a lot of things, including tinker into tier 2 bonds as well. And there's about 20,000 crores out of tier 2 bonds of Yes Bank outstanding. I'm glad that option was not looked at. While legally they could have even gone down that path, I'm glad they didn't go down that path. A lesson has been learned, hopefully, by the ecosystem, and I think we'll come out smarter for it. But yes, AT1s have to be repriced, and they should be.
Okay. Moving on to the equity side, Professor Raman, let me come to you on this first. I think on the equity side, there are two questions. One, the pricing of the equity, and that, there is a premium being paid by SBI and other investors, 8 rupees. And the second, which came out over the weekend, is that all existing investors, anybody with more than 100 shares, has 75% of their shares locked in now. Your thoughts on whether and what sort of logic is behind both of these?
Well, I have not been able to understand the logic of pricing the share at a premium of 8 rupees for the investors who came in. My own view has been that it should have been just priced at face value, because if you allow for the provisioning that is to happen, I think it's fairly clear that the net worth would be wiped out. So I think on that I'm reasonably clear. Now, as to the lock-in which has been effected for the existing investors, I think the concern seems to be that if they were allowed to trade freely, then the share price could fall considerably, and could even fall below the price of rupees 10, at which the new investors have come in, and that could sort of trigger panic among the depositors. So as it is, depositors are jittery, but if they see that the shareholders themselves are deserting the bank, and what motivation would they have to stay locked in? And the other consideration seems to be that, since many people think that, the share price should be close to zero, and it is being sort of supported at a higher price, the existing investors have an obligation to sort of return the favor by at least staying, locked in for a while. So I think the legality of this particular provision has been questioned, and I suppose it will be for the honorable courts of law to rule on the challenge as and when it comes up.
Ananth, your thoughts on this equity issue?
Oh, I completely echo what Professor Raman just said. Look, this seems very artificial, right? You've managed to get in 10,000 crores, which, along with the write-off of the AT1 of 8,400 crores, just manages to get your CET1 to 7.6%, which is slightly above the 7.375 regulatory requirement of CET1 plus the capital conservation buffer. So you kind of manufactured that. Plus now, we can celebrate the fact that equity prices for Yes Bank have gone up dramatically today, but we all know that's a meaningless number. If you restrict actual free trade in the original stock, you had 255 crores of shares earlier. Now, chances are only 25% of that can actually be traded now. Now, if you're restricting trades, it really doesn't reflect true value of the company. So I have no idea what that equity price really means at this point in time. And then, as we've all seem to agree, all we've done is create this complicated mess where the intrinsic value need not have anything to do with the equity price for the next few weeks and months. There are still questions to be asked about what this rump entity will look like. Of course, it will get saved, but there'll be a lot of attention being spent on this, both by Delhi as well as Mumbai, which is frankly completely unnecessary. Far easier would have been to just, it's distasteful, but put it into SBI, maybe give SBI some SOPs of lower CRR or whatever to compensate for doing this national duty, and then focus your attention on lots of problems which are there in front of us. Coronavirus, look what's happening to the stock markets, the economy, how do we get back growth? There are opportunities. That deserves far more attention than this amount of time you're spending on Yes Bank.